Good evening, everyone. We're just going to give it about a minute or two, let everyone join in, and then we'll start the session tonight. So what we're
Recording
is we're going to focus on the basics, just the introduction of the market, what the market's about, how does it work, how does it function, and give you guys just some input from our side, how to get started in terms of just trading. Where to start, what to do, what not to do, just the basic things. So there's going to be like introductory course, or I would say more of an introductory session. So everything that you need to actually get started. So as I said, we're just going to give it about a minute or two to see who else joins in. Now there was a raising of at least 10 people saying they're going to join in. So give it another minute and then we'll start at 8:03. If there's any questions you guys have, please feel free to ask it. We are recording a session just to upload it at a later stage for everyone who can't join tonight, so that they can go watch it on their own time. So I'm just going to share my screen for the second being. Let's do this one. Yep, so seeing that there's not really a lot of people jumping in, we are going to sort of start the session now. Okay, so there's a basic and foremost most important thing about the markets is you need to understand what you're looking at. You're looking at the foreign exchange market, and the foreign exchange market is the most basic market to start trading with. And this market is consisting of $7.9 trillion that flows through it every single day. That means from the start of the Asian session to the ending of the Asian session, there's $7.9 trillion that flows through this market consistently every single day. It might vary from day to day, but basically that's the figure that goes through it. Now, you need to start identifying this when you get into the markets and you get yourself involved in it, is that you're always going to see is the main point is of understanding who is in the foreign exchange market. And that is basically the banks. They are the money makers. They're the biggest players in the game. And they are the ones that move the money from one point to the next. If you look at like, let's say like Euro USD, that's the most traded pair in the markets. It's literally the one currency working with the other currency to get from one point to the next. And that's literally how the market works, is they don't work against each other, they work with each other. If the markets had to work against each other, there would just be no flow. The market would move more of a sideways movement. And as you can see, I'm scrolling out, the market is always continuously moving either into a bearish movement or into a bullish movement. Now, you need to understand this game or this market is a one-player game. So you are 100% responsible for everything that you do on the charts, in terms of your analysis, in terms of your trade, your journaling, your strategies, every single thing that you're trying to do it's a one-player game. There's a lot of people out there who has signals and trading floors where they try to tell you when to trade and what not to do and what to do. But you want to become independent. You want to become a trader that is responsible for everything that you do yourself. Now, the best strategy that I've found in the markets is keeping it simple. If the market is moving bullish, you're looking for buys. If the market is moving bearish, you're looking for sells. And that's the easiest strategy that you can follow. If you are overcomplicating everything on your chart, you're going to find it very difficult to actually trade the market. Now, it's the one thing that a lot of people don't understand about the market is overtrading it, thinking that there's a lot of trades in the day. Yes, there is, but you need to know if you're working with the institutions of the banks, you're going to get in on the correct trades. Like this movement today, it started with the London session, and you can see from the London session there was buys and the market just moved up. In terms of the pip count, it was a very good pip count, 60 pips. Now, the pips is literally an indication of how fast the market moves and how much the market moves. And with that, you'll be able to understand how much money you can make, how much lots you can put in, and all of that. So the first thing that you need to start understanding is that the market has two directions it can go. It's either bullish, which means the market goes into a upwards direction, or the market moves bearish, which is a downwards direction. Let me just remove all of the drawings. So we have a clean chart. So a bullish market always creates new highs. It's going for the highest point possible. It breaks the resistance. But if you're in a bearish market, it always goes to lower points until it reaches a certain point of exhaustion. Now, that's the only way the market can move, is long and short. What you have is a third market, which is a consolidation market, but that is within a direction of the market. So let's say year about was a consolidation, but the market was still creating new highs and still respecting what you would call the support region. So if I go and just brush this off and say this is the support region, as long as the market still moves bullish, we still are keeping to the supportive region. And as long as the supportive region is not broken, we are still moving bullish, and so forth and so on. And then obviously for the reversal, same. If you are in a bearish market, the market wants to go to lower points. As long as the resistance are kept and not broken, we are still moving bearish. So all that I'm doing now is I'm just following with the price, seeing that this is the last resistance, and then this became the last resistance, and then so forth and so on. And so we break the resistance, which happened here, and then we start turning into a bullish market. So with that being said, that's very easy to understand because you either have one of two ways the market can move into, down or upwards. Downwards is bearish, and you're looking for sells. Upwards is bullish, and you're looking for buys. Now, in terms of the bullish and the bearish markets, you need to understand that you can trade those markets. You can trade a bullish or bearish market. You can trade with the trend or you can trade against the trend. It all depends on you. Now, in terms of the trading, there's three basic styles. Three types of trading that you have. Is you have intraday trades. Now, intraday trade is you're going to go on the lower time frame, and you'll find certain entries that you also find from the higher time frame, but you're looking to hold the trade a very short period. That means anything from 1 minute up until, I would say, 4 hours. It's an intraday trade. Now, if I go here by the tools, here to the left side, you have all of your tools, and here you can have your prediction tools. I'm just going to go and push an example of a long position. So let's say this right here was your supportive region, and you were looking for buy just because of the supportive region, and you took a position of it. It's an intraday trade. You're not going to hold the trade too long. So let's say you took it there in the middle, and you have a very small stop loss. Also for intraday trades, you're trying to reduce your risk. Let's say you went for 5 pip stop loss, and you just targeted about, let's say, 30 pips. You have about a 1-to-6 ratio, give or take. So if I'm going to go and refine it, you can see on the tool here, you have the risk to reward ratio. Now, this is the main thing in terms of Forex. It's literally a numbers game. If you can risk less and reward yourself with more, you are going to be profitable and you're going to endure long in the market. Now, if you look at this as a price and data range, the intraday trade, as I said, it's going to take anything from minutes up until 4 hours. You can sometimes push it to 6 hours, but as long as it is within a session. If it goes above and beyond a session and goes 8 hours, then it's considered. The next thing is called a day trade. Now, if you are holding the trade to a longer point, so let's say this was the resistance level, and you were targeting just the resistance level from the support to the resistance level, you took an intraday trade, and it took you about literally 6 hours to reach your target from the point of entry to the point of exit. 6 hours. Now, this is considered an intraday trade. So I'm just going to label it intraday trade. Okay. Now, an intraday trade, as I said, this requirements is anything from from a few minutes to an hour. Now, the reason why this is a very easy way to trade is because you're in and out of the market very briefly and very fast. What you could also have done is just like take a small movement. So you're still risking a 1-to-3 ratio, and you're taking a trade out literally within a few hours. So this would have been literally a trade that took you 1 hour to get your entry in and get out of the trade. And that's a 15 pip movement. Still, you have a good risk reward ratio, a 1-to-3 ratio. So what that means is if you have 1 win, you need 3 losses to break even, which is a very good ratio. Then in terms of the intraday trade, moving to a day trade, now let's say you go for a full session. The session is normally 8 hours, and you went for this resistance level here. So what I'm just going to do is I'm going to also just label it and show you. Okay, so you went for this resistance level here. You went for 45 pip movement, and you have a better ratio, and your ratio is increasing to 1-to-9. So you're risking still 5 pips, but you are rewarding yourself for 45 pips. Now, this would be considered as a day trade, and majority of the people in the market, majority of the retail traders in the market falls under this category where they day traders. Then the last type of trading that you have is called swing trading. Now, I've shown you on the low time frames what you can do, but swing traders hold trades out for a very long period. Now, let's say the same principles that I've applied here, and you're looking for buys on the support region, and you're looking to hold it all the way to a resistance region. Let's say, yeah, because then you can have a live example. We're not going to wait for price to still reach that certain level. So you're still trading resistance and support, but you're just trading it on a higher time frame. So let's say there you had resistance, and now it stays resistance. And you're looking to take entries at this region, and you are swinging this position. So let's say in the middle of this block, and your risk reward ratio, you still want a good risk reward ratio, but now you're not risking 5 pips, you're risking about, let's say, 10 pips. 10 pips, okay, cool. And you're reaching for this high point, you're targeting 170 pips. You have a ratio of 16. Let's just do this. There we go. You have a ratio of 17, but now let's look at the time span that it took you to get there. So from the point of entry, which was here, to the point of exiting the trade, it took you 12 days. Now, in terms of an intraday trade, it takes you minutes to an hour. A day trade can take you anything from 8 hours to, let's say, 2 days maximum. That's still considered a day trade. But then, if you go for a swing trade, you're holding the trade over a period of days to weeks to even months if you can. Like let's say this short position, this could have taken you from May up until this level here is August. And August was a very good time to get out of this trade. That's a few months. Now, this example of a swing trade was literally taking you about 12 consistent days of just holding your trade. Now you can see, let me just put it up, swing trading. Now you can see with this example, once we've entered the market never came back. It kept the support level all the way until it reached the resistance level, and we've reached our target. These are the 3 types of trading styles that you can have. And depending on your personality, you're going to choose one that's going to work for you. Either it's going to be intraday. If you're impatient and you want to be in and out of the market very quickly, I would suggest you go for an intraday trade. If you are someone who can hold the trade a little bit longer, but you want to be in and out at the end of the day, you go for day trading. You're going to catch a bit more pips. And then the last thing is swing trading. If you're very patient, you can wait for full movement to play out. You can go for swing trading. And this would be the best type of trading that you can actually go for, swing trading, because you're going to gain the most amount of pips, the largest movement, and everything that goes with it. Now, pips is literally the measurements of how far the price is moving. So it's called Let me just get the PIP calculator here. It's called percentage in profit. That's what PIP stand for. And the PIPs is measured from where you entered your position to where you've exited your position, or where you've entered your position or taken a loss. Now let's go into that a bit. If you're taking a trade and the trade goes into a loss, that means your stop loss is stopping yourself out before you lose your equity. If you have, as an example, $1,000 in your account, you want to preserve that capital. You don't want to have a trade going against you too long, because then you're denting your account. You're going from $1,000, let's say, to $900. That's a very bad way of managing your risk, because then you're losing 10% of your account on one trade. But let's say you have $1,000 and you're willing to risk 5% of your account on a 10 pip stop loss. You are still putting yourself in a position of taking 20 consecutive trades before you lose your account. But if you take one win with this example, you can literally increase your account to 170 pips, depending on what your risk reward ratio is. Now, that being said, what you want to focus on is when you enter the market is that you have also proper risk management. Now, it doesn't help you just take trades. You want to make sure you have risk management in place. Now, the risk management goes hand in hand with lot management. Let's copy this over. Okay, cool. So your risk management, you want to normally have at least a 1-to-3 ratio. That means you're risking 10 pips, getting yourself rewarding for 15 pips. This would be the intraday trade. The day trade would be risking 10 pips, but reaching for 30 pips, or risking 20 pips for 60 pips. That is to give you that risk reward ratio, or even 15 pips for 45 pips. That is still a good risk reward ratio. So that's risk management. So you want to always keep the risk management when you're trading, because that keeps you going forward. So you're going to have at least 3 steps forward, 1 step back, 3 steps forward, 1 step back. And as long as you keep your risk reward ratios consistent, you'll always be making more money than losing money. Now, lot management goes in a direct correlation with the risk management. If you have, as I said, $1,000 account, and you are willing to risk 5% on each trade, that basically means that you are always keeping yourself in a position of increasing your account. If you can't keep the risk management, you're always going to start losing, and it becomes a very messy disaster, because then you're trying to make back money and you're not really getting yourself ahead. So 5% risk would be about $50. Now, if I'm willing to risk $50 every single time that I take a trade, I can calculate how much am I willing to risk and how much am I willing to win with a 1-to-3 ratio. So this is the FXTM calculator, and it's a very simple and easy calculator to use. You have your pip amount here at the top, and you can push in your value. So let's say we go for a 30 pip intraday trade. Let's use the example that we actually got you on the screen. So let's say this one for 5 pip for a 15 pip movement. So we said this was the first one. 30 pip movement. So yeah, that was correct. So we're going for 30 pip movement, and we are trading what currency pair? We're trading GDP USD. I just quickly want to calculate the risk. So 5. The currency that we're working with is what's the US dollar. So if you're trading off one lot, you're risking $50, which is in our trading plan, because you want to work with a plan. You are still risking 5% of the $1,000 account. But in terms of your reward, if you win, and you win on a 15 pip, which is a 1-to-3, you are rewarding yourself of 150 pips. That means you're growing by 15%. But if you're taking that full intraday trade, you're rewarding yourself with 30% on your account, just of one trade. Obviously, as you go for the different type of styles of trading and you go for more of a day trade and you're stretching yourself for a 65 pip run, you are looking to increase your accounts of 60%. And obviously, if you go for the swing trade, you're looking to increase your accounts a lot further than you would with an intraday trade. But then look at the time. It requires you 12 days of holding before you even get to your profit margin. So all of these ups and downs is going to test your patience, because once it pulls back, you're going to think you must take out your trade. But if you're patient, you can hold yourself out until you reach the resistance. You're taking out a growth of 170% growth just of one trade. Now, all of this required you is to follow a trading plan. You want to decide what is your style that you're going to trade with. What is the risk management that you're going to follow? What is the lot management that you're going to follow? And I would suggest when you start trading, a 5% risk is a more of an aggressive way. If you want to, rather go for a 1 to 2%, because then you have a longevity in the market, meaning if you're going for 2%, you can literally take about, I would say, almost 80 to 90% of trades losing. And then when you have one win, you actually have a good win. It can actually put you in a good position. So in the start, when you're starting to trade, you're going to see yourself having more losses than wins. So as an example, 2% of the account. So let's say you have let's say you have a 10 pip stop loss. You're willing to risk 2% of your account. You're going to go for 0.2. Now you're looking to take trades very conservatively, but if you're rewarding yourself with the same ratios, you're looking for a 6% increase. So you're risking 2% to gain 6%. Now this means you're going to stay a lot longer in the market. And this is where it comes to, is when you have a winning streak, you want to always withdraw your profits. A lot of the people stay in the market and they want to take $100, $1,000, $1,000, $10,000. When you make money, take it out and trade with the market money, because then you're enjoying actually the Forex lifestyle. It doesn't help you trying to take it $10 account to $100 and then take that $100 to $1,000 if you're not really living off the money. And when you start taking a losing streak, take a break. Don't try to force trades. Don't try to force direction. Don't try to force your trading, because the market can only move in one of two directions. And if you are losing consistently, that means you're not trading with a trading plan. You're not trading with something that works for you. So you need to understand what is something that works for you and what is something that doesn't work for you. So the easiest thing to start with is going for major phase. Now, if you go here on your trading view to the right, on your watch list, you can add pairs. Now you can go for stocks, futures, Forex, CFDs, cryptos, index, economy, whatever. I normally go for the Forex, and then you want to start with the major pairs. Major pairs are pairs of the USD in it. So if you go like if you go like for the Euro USD, if you go for the Pound USD, Pound Yen is considered a minor pair. Still has a very strong currency, but then the sub currency is a weak currency. Major pay, this is also a major pay, has US dollar in it. US dollar also major pay. And then the Euro Japanese Yen is a minor pay. And then also the Pound Australian dollar is also a minor pay. It's not linked with the US dollar. Now, when you start trading, don't go for the funny pays, meaning the what's it? I think they call it the erotic pays. Now, an erotic pair is something that is not of value. Like let's go, for example, USD Zara. This is not a major strength pair. I'm going to use as an example because this is the South African Rand. This is an exotic pair. Now, the exotic pairs are very volatile, but the amount of pip value is not that much. So let's say we use a calculator to determine if you're looking for a 10 pip stop loss in GDP USD on a standard lot, that would be equivalent to $100. But if you're looking to take that same trade on USD ZAR, which is the South African Rand, your value is $6, literally. So you're going from $100 to $6. So rather stick with the major pairs, and you'd actually have value for your trades that you're taking. But if you're going to trade minor pairs, you're going to have a very difficult time actually to make the money that you want to make. So let's say GDP USD. There we go. Just quickly want to see, there's a message that came in. Okay, no, all good. So you want to trade the major pairs. You don't want to trade the minor pairs because they don't give you value for your money. You want to stick with the pound dollar. If you want to, also the pounds Australian dollar is also very strong. It's not as strong as the pound dollar, but it still gives you good money. It still gives you good value for money. Now, the other thing that you need to start understanding is when you're trading the foreign exchange market, let's just go back into GDP USD, you want to be focusing on the different sessions. There are 3 major sessions in market. Those sessions are London, and London starts at 8 o'clock. Now, take in consideration, my timing is set for London. Now, when I showed on the chart, you can see London opens at 8 o'clock. So what you can always do is you can go and vertically analyze the market accordingly. So London opens at 8 o'clock. And what you can always do is just label it. Say, click on it, settings, London open. And then every day at 8 o'clock, you see what happens with the market. If I go to the previous day at 8 o'clock, let's say day, you can see there's a movement normally that happens after London opens, whether it's a retracement or whether it's an impulse. Literally, there's always a movement that happens when a bank opens. Now let's look at the next impulse. Yeah, this was at 1 o'clock. 1 o'clock is the New York bank open. So New York session opens at 1 o'clock in the afternoon based off London time. And then you have the Asian session that starts at midnight, 12 o'clock. And you can label it also as your Asian or your Tokyo session, Asian session. Now, identify each bank has an 8-hour period that it runs out, or each session has an 8-hour period that it runs. So let's say we took a trade based on the London session. It runs literally for 8 continuous hours, and then the bank closes. So you can see this whole movement into the upside was from the bank opening of London to the bank closing of London, which goes with the European market. So this you can also call the European session. That's 8 hours. Now, if I go into the New York session, the New York session starts at 1 o'clock, but then it ends at 9 o'clock, and it's still in play, it's still running. And then that session ends, and then you start having the Australian market starting to open. There's normally an hour period where there's no banks open. That's normally at 9 and 10. And then from 10 o'clock, you have the Australian market starting to open. All of the Asian session starts to open. And then the Asian session continuation starts at 12 o'clock. Now, this is the interesting thing, is the Asian session ends when the next London session opens, because it's an 8-hour period. Now, this is what you need to identify is when you're in the markets, you want to trade with the sessions. You don't want to trade against the sessions. Bank openings, bank closings, you can see literally what happened in this day. Let me just get the risk-reward ratio. So if you took a trade just based off the London open and the London closure, you would have capitalized on a 50 pip movement just from entry to exit. Now, if you go into, I'm going to give you a realistic view of it, and you have a small account of like, it's $100, because you're probably going to start with $100. You're looking for a 25% increase in your account. Obviously, as time goes on and you progress yourself, you can go for $500 day, even $1,000 day. It all depends on how confident you are in your trades. Now, this is the next thing that comes into the play in terms of the market is psychology. Psychology is vital because you can understand the technical side of everything in the markets. You can understand your intraday trading, you can understand resistance, support, all of that. But if you are not confident in what you're doing on the chart work in terms of your analysis and taking and executing the trades, you can forget about actually being in the markets. Because if you are having a mindset of, I am not worth it or I can't trade, it's definitely going to reflect on your chart work. It's definitely going to reflect on your trading. Because if you think and feel you can't trade, it's going to give you that mindset when you come into the charts, and you're not going to know, am I looking for a buy? Am I looking for a sell? Am I looking to trade with the banks or against the banks? I'm going to go with a retail mindset or not. And we want to teach you from the start as the institutional mindset. So I'm going to end off the session by saying, when you trade, you want to focus on price, timing, and structure. Now, if I'm just going to give you one golden nugget to start trading, just by using this introductory session, is I've looked at a support with a specific price where I want to enter, which is where the market turn around. And also, I'm looking for bank opening. Now, if I'm looking at London opening, let me just pull this aside. I'm looking at London opening. I'm looking for a support level being kept. So you can see London opens at 8 o'clock, goes back, fetches liquidity based off the support level, and then the trade plays out 100% to the exit point. So you're looking for three things. You're looking for structure, you're looking for timing, and you're looking for the price that you want to get in. As long as you do that, you are working with the banks. If you're not working with the correct timing, you're working against the banks, because the banks are going to use the 8-hour period to utilize that whole timing to go from the entry to the exit. And then again, obviously for the next session, this pullback was for the New York institutions to also get in on the trade, which was, again, just if I go in terms of the technical side, the resistance became the support. There was a secondary entry. But now you're looking for an intraday trade, even to a day trade, if you look at it in that way. But this will conclude the session in terms of the introduction to the markets. I'm going to stop the recording. If you guys have any questions, you can ask it. Anything that was unclear for you,